Is universal life a good idea? In this educational episode, I'm going to explain that, in my opinion, nothing else that I'm aware of in the Internal Revenue Code allows you to accumulate, access, and transfer your money totally income tax free. I've challenged many CPAs and tax attorneys to show me anything else in the code that does that, and I've yet to have any of them come up with anything that comes close to a max-funded universal life. So get ready, I'm going to explain why. So I'm Doug Andrew. I've been a financial strategist, tax minimization specialist for now nearly 5 decades. And my favorite financial instrument that allows my clients, and I've helped thousands of people do this, accumulate their money for long-term goals totally tax-free, income tax-free, and then be able to access that money income tax-free. But at the end of the day, when they finally die, when they pass away, anything that is left behind in the account blossoms, increases in value, and transfers income tax-free. And that is a max-funded universal life, which was first introduced by E.F. Hutton back in 1980. And interest rates were high back then. And so from 1980 until 1990, I never got credited less than 11.75% during that first decade when universal life was introduced. I got credited as high as 15.5%. But then interest rates started to come down in the 90s, and they introduced indexed universal life in 1997. And that is my preferred instrument so that I can still, in a low interest environment, earn rates of return averaging 11, netting 10 on the average. If you use indexed universal life, you diversify and you rebalance regularly. And this is what a very savvy, trained financial professional who's a specialist in IUL can help you accomplish. If you just sort of fell asleep like Rip Van Winkle in the worst decade since the Great Depression, 2000, and then woke up in 2010, and you didn't diversify, you did not rebalance, and I'll explain those terms here in just a moment, you would have earned 7.23%. Now, if you understand Rule of 72 math, you divide 7.23 into the number 72, it means your money would have doubled in 10 years in that decade. So if you had $1 million in the year 2000, in the year 2010, it would have been worth $2 million. And that's what happened with many people. That's just using indexed universal life. That year, or that decade rather, there were 5 loss years and 5 gain years. Most 10-year periods, there are 7 gain years compared to 3 loss years. Well, if you understand indexed universal life, your money is not at risk in the market. It's safely tucked in the insurance company. So that $1 million sat in the insurance company. And during that decade, the general account portfolio rates were about 6% on the average with most insurance companies. And they need about one of those percentage points for their profit. And so the net crediting rate was around 5%. So you can just sit there and leave your money earning 5% if you want. But 5 into 72 means it would take 14.4 years for your money to double. Well, we were able to double our clients' money in 10 years by using indexing, see, because you're able to take the average return to about 2 or 3% higher than the general account portfolio rate. Now, if you do not understand indexing, I would strongly recommend you explore some other educational videos on this channel, but in a nutshell, it just means you're not telling the insurance company to take your $1 million and invest it out in an index mutual fund. That's what some agents think. That's wrong. What you're doing is you're telling the insurance company, take the interest on your $1 million, in this case 5%, and that would be $50,000 of interest, and do whatever they need to do with that $50,000 of interest they're earning on your $1 million to have the wherewithal to pay you whatever the index does that you chose. Now, if we're using the S&P 500, that means if the S&P went up and it it went up 8%. Then that 50,000 of options allowed the insurance company to pay you 80,000 of interest, or 8%, or 12. The caps were usually 16%. So there were some 2 years in that decade where we capped out and we got credited $160,000 in 1 year on that million, or 16%. But when the market crashes or goes down, the options expire worthless. You don't lose your million because your million is not in the market, but you do, the options expired worthless. And so by falling asleep and waking up 10 years later, that means 5 years those options expired worthless. You didn't make anything, but you didn't lose. The other 5 years you made money, but only 2 of those years did you cap out, but your average return would have been 7.23%. Your million would have been worth $2 million at the end of 10 years. Do you know that people who had their money in the S&P, in the market, that $1 million in 2000 went down to 600,000. It wasn't back to $1 million again until 2012. By then, many people with indexed universal life had 2.5 to even 3 times their money. How? Well, you can tweak your rate of return by rebalancing. So just simple rebalancing is what we did with some of our clients. In 2001, when the market went down after the 9/11 terrorist attacks, we didn't sit there and just settle for zero. Zero is your hero when the market crashes because you're not losing, but you don't make anything. You don't have to sit there at zero for 3 consecutive years. So in 2002 and 2003, we said, you know what, the market's continuing to go down because of 9/11. So just move back over and earn the 5%. Same thing happened after 2007 crash. In 2008, we said just move over and move 5. So instead of having 5 years of zero, we only had 2 years of zero. The other 3 years, they earned 5%. And people were able to average 11.17. Well, I also teach on this channel how to diversify, and I teach sophisticated IUL agents how to diversify so that you could maybe have 40% of your money in a 1-year point-to-point, 40% in a 2-year point-to-point, and maybe 20% in a 5-year point-to-point, okay? You diversify, or you sometimes are able to move money over to a 1-year point-to-point with no cap. Now, if you don't know what I'm talking about, search some other videos on this episode, because many of our clients from March of 2020 to March of 2021, because of COVID-19, locked in gains of 61.33% because we were able to rebalance. So this is how I have been able to earn an average return of 11.17, netting 10.07. Since that means cash on cash, 10%. Your money doubles every 7.2 years, ever since Index Universal Life came out. But ever since 1980 until today, I've averaged 9.62. So if you round that down to 9.6 and divide that number into the rule of 72, your money will double every 7.5 years. So what does that mean? Well, yeah, we've had people who maybe started out with $500,000. They didn't add a dime, but that $500,000 doubles every 7.5 years to $1 million. $1 million doubles to $2 million and another 7.5. $2 million doubles to $4 million and another 7.5. And $4 million doubles to $8 million at the end of the 30th year. 30 years, $500,000 doubled, okay, and it's now worth $8 million. We have clients with $8 million tax-free, generating $600,000 to $800,000 a year of tax-free income. This is incredible. So is Universal Life a good idea? Yep, but Indexed Universal Life is even the best idea. If this is intriguing you, you need to understand how it must be structured correctly and funded properly. So I want to gift you a copy of my most recent best-selling book. It's called The Laser Fund, which is actually 2 books in one. If you're a left brain learner, you learn by the charts and the graphs and the numbers. You read this side, which is about 200 pages, 14 chapters. If you learn more by stories and examples, you flip it over, and this is about 100 pages, 12 chapters with 62 actual client stories of how a properly structured IUL contract can be used as a superior cash accumulation tool for living benefits, for retirement, college funding, working capital for business, real estate management, emergency funds, you name it, okay? It's like the dream solution. If you want to use both your right brain and left brain, then read all 300 pages. But instead of paying $20 on Amazon, I want to gift you a copy. So you can claim your free copy by going to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost. I'll pay for the book and fire out a hard copy to you. And while you're in there, if you like to listen and learn or watch and learn, there's options there for those mediums. But check out our regular educational webinars that we do. There's no charge, and you can even schedule an appointment with an IUL specialist that I oversee, so you can see how one of these could be structured correctly in your particular set of circumstances. But this is about you and your brighter future. Explore why it may be a good idea for you.